Welcome to our self-directed IRA and solo 401k question and answer session. My name is Brett Synicky. I'm a consultant here at Sense Financial. Before that, I was a real estate investor starting in the mid-2000s, and I've had my California real estate license for about 10 years. I'm joined here by founder and president of Sense Financial. We are a boutique financial firm that specializes in self-directed retirement accounts with checkbook control. Dmitriy Fomichenko. Dmitry and I will be taking turns answering the questions today. So thank you very much. Dmitry, welcome.
Thanks, Brett, and thank you all for joining us. We do have a number of questions here that were pre-submitted during the registration, so we're looking forward to diving into those. And I just want to encourage you guys to type your questions and in the Q&A section of the webinar. You can type your questions there, and once we're done answering those pre-submitted questions, we will get all the Q&A questions that were submitted during the live session.
All right, so with that, let's jump into the first one. So this question was submitted by Lucy. Lucy says, if the workers do not have their own tools, can they use tools, not materials, that belong to my company? Every single material they will be using for the renovation will be bought by the trust in the name of the trust and using the trust bank account and debit card.
Good question. And maybe to give a little bit of a background, actually remember Lucy's situation. She's a client and she has a solo 401k, and she wanted to rehab the property in her 401k. And so Lucy wants to use the tools that belong to her business for the rehab of the property that belongs to the 401k. And the answer will be no. You cannot use or provide that will be considered a personal contribution. So you can't do that. You have to outsource all the work. Independent third party will have to do all the renovation work, and you can only oversee and manage the project remotely. You can be personally involved. You can provide the tools or any other resources for that project.
Okay. And then she has a couple follow-up questions. When selling this house after renovation, is there anything specific that I need to do / file report to the IRS?
When selling investment inside of a solo 401k, you don't necessarily need to report that particular transaction, but a couple things involved. It looks like you might be describing here a flip. If you're trying to flip a property inside of your solo 401k, generally speaking, flipping can be considered an active business. So if you run an active business inside of your solo 401k plan, then the profit from and gains from such activity may be subject to unrelated business income taxes, because the unrelated business is subject to taxation inside of a qualified retirement accounts. So be sure to consult with your CPA. Certainly that will apply if you doing this on continuous and repeated basis. If you're just doing a one-off, maybe if you doing a number of private lending transactions, maybe you have a number of rentals and you just happen to do one a flip, and your intention was to hold on to it, but you just got an offer that you didn't want to pass on, then that probably be okay. But you want to be careful as far as running the business from your 401k, because again, that will be subject to taxation. You will have to report that income using a form 990T. So check with your CPA for details.
Yeah, and I'll add real quick on that. People often ask us, why is there tax sometimes paid when you are running a business within a retirement account? And the simple answer is that is the IRS's way of leveling the playing field against you running a business in a tax deferred or no tax down the road in your Roth IRA business within that versus all the other private business owners who are running a business and having to pay taxes for running that business. So this is the IRS's way of leveling that playing field to make it fair.
Yeah, good
Okay,
point.
her last.
Yeah, just retirement accounts in generally been designed for you to invest your money passively. So you want to make sure you understand the difference between passive investments and an active business.
Yep. Okay, her last question. I am planning to only do some measuring in the house to determine what size cabinets are needed for me to order. Is this okay?
That will not be okay, Lucy, because if you personally want to engage in certain activities there, you're not allowed to do so. You will have to outsource. Somebody else will have to do the measurement and all the other work, not yourself. So you are only allowed to provide administrative functions to the 401k. You are the plan administrator. So it's okay for you to pay the bills. It's okay for you to decide which contractor will do certain work. It's okay for you to decide the type of material, the quality, the colors, and so forth that will be used on that particular project. But all the transaction must be hands off. So in other words, you can be at your desk doing the kind of oversight from your desk, but you cannot be hands-on. So that is something that you want to delegate to somebody else.
All right.
Thank you, Brett and Lucy. That's a good question. Let's jump to next question from Annabelle. And Annabelle is asking, I have a solo 401k and I heard that deadline to contribute was April 15th. I filed for an extension on my taxes and I thought that I could contribute by October 15th. Is there something I can do now? Brett, you want to take this one?
Yeah, sure. Yeah, great question, Annabelle. One we get often, especially around tax time. And well, there's two answers to the question. If there's two buckets of contributions for the 401k. You have the employee deferral side, and then you have the employer or profit sharing side. Now, if you are, I'll take the S Corp status to begin with. If you're incorporated, you are and should be on a payroll. Your contributions on the employee deferral side actually have to be made through payroll. Okay, so, and that has to be done within 3 days after paying yourself. So to do that, you have to actually have paid yourself. Those contributions would have been made on the employee deferral side in 2023. Okay, so that doesn't go all the way till filing April 15th or October 15th or whatever S Corp status. Now, if you are sole proprietor, single member LLC, yes, and let me back up a little bit. On no matter how you are set up, whether it's sole proprietor, S Corp, or single member LLC, partnership, whatever, on the flip side, you can actually make the employer or profit sharing contributions all the way up to the date of filing before you file, right? So that could be April 15th. It could be October 15th if you extend. Okay. Now, if you're a sole proprietor and you're not on payroll, you're just making the employee contributions. You're making those by the time you actually file. So you can make those all the way up to October 15th. So Annabelle, we don't have all the information on your question. Depending on how you're set up, hopefully that helps. And so the answer is yes and no on the employee side and yes on the employer side. Hopefully that's clear. It can get a little bit muddy with the numbers and the different buckets of contributions. So if Dmitry, anything to add on that, please feel free.
Yeah, great job addressing that, Brett. The bottom line is that if you're incorporated, the employee portion contribution has to be done through the payroll, and it's obviously too late for that. The last payroll been done in December. But if you're sole proprietor and trying to make your contributions and you file for an extension, then yes, you can do that. And if you're trying to make your profit sharing contributions, yes, you still have to do that. You have time to do that, assuming you file for an extension, because once you file your taxes, you cannot make the contribution. The contribution must be done before the day you file your taxes. So great job. Moving on to the next question from Vinay, who's asking, what is the limit on IRA contributions in addition to the 401k? Brett, you want to grab that one?
Sure. Yeah, I mean, they're really two separate conversations, right? IRA contributions are totally separate from 401k contributions, okay? Whether it's a traditional 401k with an employer, solo 401k, it doesn't matter. They're two separate things. With the IRA contribution, that's annually, that's $7,000 a year, $8,000 if you're over 50 for the catch-up contribution. And then currently for 2024, the traditional 401k, because I'm looking at this in the question as a W-2 employer 401k, the employee contribution is up to $23,000 or up to $30,500 because you get a $7,500 catch-up contribution if you're over 50. And that employee contribution on the 401k applies to the solo 401k that we offer here at Sense Financial, in addition to the traditional 401k that you might have at a W-2 job. So those are two different things. You can do both. You can do one or the other, but they're totally separate from each other.
Yeah, just to add that typically on the 401k contribution, there is no income restriction. Regardless what your income is, you can make the 401k contributions, but an IRA contribution is subject to the income restriction. So if your adjusted gross income is over a certain threshold, you may not be allowed to make deductible contribution. You can still contribute to a traditional IRA, it just will not be deductible. So again, be sure to work with your CPA and know your numbers.
Yeah, great, thanks. Okay, this next one comes from Steven, and Steven asks, is it possible to trade futures as a bit? I'm assuming he's talking about day trading as a business to make contributions to a Roth IRA or Roth 401k?
Well, Steven, to contribute to an IRA, you need to have earned income, and any earned income will work. It might be possible depending how your business is structured. So you want to, again, check with your CPA and see how that income that you're earning is reported. If you're talking about a solo 401k, then you have to have business income or self-employment income in order to have a solo 401k and make contributions to a solo 401k. And typically for trading, it needs to be structured as a business. You can do that as a sole proprietor. But again, that's something that you will want to discuss with your CPA, because there could be various ways that you report in that. So you want to make sure that your CPA is part of this conversation. And the bottom line, to contribute to a solo 401k, you have to have legitimate earned income from a self-employment activity or a business that generates that earned income. All right, so let's move to the next one. And just as a reminder, you guys, as we're talking about here, there is a Q&A session here that you can click and write your question. And once we're done with all the questions that were pre-submitted, we'll jump into the questions that were submitted during our session. So take advantage of that. Next question comes from Patria, and she's asking, is there a deadline for payment when I borrow from my solo 401k? Brett, go ahead and grab that one.
Yeah, and good question. And there is, yes. Now, for those of you that don't know, the solo 401k comes with a participant loan option. This is not available with an IRA. And the participant loan option allows you to borrow up to $50,000 or 50% of the total plan asset balance, whichever is less. And you can actually use that for virtually any purpose. In fact, some people that have a solo 401k, our customers, our clients, come to us and they want to do an investment that might be prohibited, right, with a disqualified person, parent, son, spouse, whatever. Well, they cannot do that with their solo 401k funds. However, they could take a participant loan and use some or all of that participant loan money to invest in a transaction or investment that would otherwise be prohibited. So that's one reason why people do it, but you can use it for virtually any purpose. Okay. Now, if you just borrow the money and you use it for anything except for buying a primary residence, you're going to have to pay it back over 5 years. It's usually paid back at an interest rate of prime plus 1% and amortized over 5 years. You can make these payments monthly or quarterly. All of this you would decide when you're filling out the loan paperwork. And then if you borrow the money for a personal residence, it's actually paid back, or it can be paid back up to over 15 years as far as the amortization goes. Same thing applies monthly or quarterly, and prime plus 1%. So the benefit to this, of course, is, if you need the money to pay off some high interest debt or whatever it might be, you're borrowing from yourself, you're paying your retirement back. Well, really not from yourself, from your retirement account, and you're paying your retirement account back instead of some other lender. And so you're still growing your retirement account as a result of making those payments back to your retirement account. So that's the participant loan option.
Great. Thanks, Brett. Next question comes from Ty, who's asking, can a regular IRA or 401k be used to change into a solo 401k? I think what he's trying to ask is, can you roll over or convert your regular IRA or 401k into a solo 401k? And go ahead, Brett, take this one.
Sure. Yeah. Thanks, Ty, for that question. And this is something that most of our clients do, absolutely, because the answer is yes. You not necessarily change, you roll over either a 401k from a former employer or a regular IRA into your solo 401k to be able to self-direct it. And the 401k typically has to be from a former employer. There are some exceptions to that, but they are very few and far between. So it can't hurt to ask. But 99.9% of the time, it's going to have to be a former employer 401k to be able to roll over into a solo 401k. And then the regular IRA, it's individual, you own it. You can roll that over into a solo 401k and begin self-directing. And it's important to note that there's no tax consequences for this. There's no penalties, and you can do the whole balance, or you can do part of it. You can do some this year. You can do some next year. There's no limit to the amount of rollovers you can do. There's, again, no tax consequences or penalties assessed as a result of doing that.
Yeah, and just to expand on that a little bit, is a solo 401k will accept rollovers from any other qualified retirement plan with a single exception. And that exception is as of now. And as of now, that exception is a Roth IRA. IRS does not currently allow Roth IRA to be rolled over into a solo 401k because they're treated a little bit differently. There are some differences on how they're treated. But there is actually a current legislation that is proposed, which may change that. So the Congress is currently considering allowing Roth IRA to be rolled over into into 401k, into employer plans. That includes the Roth sub-account of a solo 401k. So that might change in the future, but that's not the case as of right now. But any other retirement account can be rolled over. And as Brett mentioned, you can move as much or as little of an IRA. If you have an IRA, you can move any portion of that into a solo 401k. If it is employer-sponsored plan, such as old 401k or perhaps a 403b from the previous employer, typically those will have to be moved in the entirety. The entire balance will have to be moved when you're trying to submit that rollover from the previous employer 401k. But you got to check with your 401k on that.
Okay. All right. Thank you, Dmitry. Next question. Susan says, I have a property that I share ownership with my deceased partner's heirs. Can I buy it out with my self-directed IRA?
Thank you, Susan, for the question. It's a little bit unclear. I don't fully understand that. I don't think we have a full picture here. But if you own a property currently with someone else, and you're trying to perhaps buy a portion of that with your self-directed IRA, so most likely the answer is going to be no. Again, I don't fully understand your situation here. I probably need to speak with you to get a full picture here, but it looks like you're talking about a transaction with disqualified person because you currently have ownership and you're trying to buy out a portion of that property. Remember, when you're engaged in a transaction with your self-directed IRA or self-directed 401k, the rules are the same for an IRA and 401k as far as prohibited transaction. Yourself, your spouse, and your immediate family members, meaning your kids, grandkids and their spouses, your parents and grandparents. So remember that vertical line. So those individuals, the immediate family members, cannot be involved in the transaction with your 401k. So it has to be arm's length transaction. So when you're looking at the transaction of the 401k, you got to ask yourself a question. Am I involved in that transaction somehow, directly or indirectly? And if the answer is yes, then that will be a prohibited transaction. And it looks like that's what you're describing here. Again, without knowing all of the details, most likely that's not going to work. But Susan, feel free to reach out to me directly. Call our office, schedule a consultation with myself or Brett, and we'll can dive into that deeper. And with that, let's move on to the next question coming from Diva. And he is asking, how does LLC play a role after establishing 401k trust? Can we add 2 participants?
Okay, so Diva, thank you for the question. And what I think you're asking, so for the solo 401k, let's talk about what you need to have established to be able to be eligible for a solo 401k. So there's 2 things, essentially. You have to have legitimate self-employment activity, not a hobby. This is a legitimate business that you're trying to earn money in. Because you need to have a sponsoring business for the 401k. So you have the sponsoring business, but then also no W-2 employees other than you and your spouse. And that's what it's designed to be, hence the word solo, right? You and your spouse. Two shall be one when you get married, right? You and the spouse. Now, can we add 2 participants? So what I think maybe, Diva, you're asking, and feel free to reach out directly if we're not getting this correct, is your one spouse is potentially running the company, and you want both of you to be able to participate in the solo 401k in terms of contributions. And can we add 2 participants? Yeah, you can. So if one spouse has the business and they're running the business, you as the other spouse can actually get on payroll and also begin to make contributions to that solo 401k. And so there's, probably some nuance involved as far as, work that you're going to do or not do and then get paid for. You want it to be legitimate. You're going to earn a salary and make contributions through that salary. But, if you have more on that, or we're not answering the question specifically, feel free to reach out. And Dmitry, anything to add on that?
The bottom line is that if if you own a business and both spouses are employed in this business and receiving compensation, then yes, both spouses can participate. I know the name solo 401k can be deceiving a little bit, because you may think it's just solo means one, but as you said, Brad, both spouses can participate if both of them are part of the business and receiving compensation. In fact, it doesn't have to be a spouse. If you own a business with a partner who is not, doesn't have to be your spouse, it can be your friend or a sibling, or maybe even multiple partners. We've done a solo 401k for a business with 4 partners. We actually still have those clients on the books. So it is possible, 4 partners, no employees, just 4 of them, and you can have a solo 401k and all participants can contribute.
Okay, thank you. All right, let's see. So next one is from Justin. And Justin, thank you for your question, is asking, what are some of the most popular investments in self-directed IRAs? My thought is mortgage notes.
Justin, what are some of the most popular investments? Well, probably some of the most popular investments, just looking back into my experience doing this for last 14 years and just talking to folks, some real estate investment related investments are probably the most popular. So people do buy rentals, people do invest in commercial real estate, multifamily real estate as limited partners. Yes, mortgage notes is popular. This is probably one of my personal favorites. That's how I invest my retirement dollars primarily. I think it's a great way to invest, but again, I'm not sure if I can pinpoint just one most popular, but probably real estate related investments will be just as a general group. That will be my answer. All right, next is a question from, I hope I won't mess up your name, Muthu Kumar. Again, I apologize if I mispronounced that, but he's asking, which financial institution will manage my 401k account? Fidelity is not managing the non-prototype accounts. Brett, take it away.
Yeah, sure. Thanks. Thank you for the question. Well, there is no, I think by non-prototype account, you mean solo 401k. Well, there is no financial institution. With the solo 401k, you are, especially with the solo 401k with checkbook control, you're the trustee of the solo 401k. So you are the institution, to use your language here, that is managing your 401k. You're responsible for the bookkeeping aspect of it. You're responsible from a fiduciary standpoint to invest in investments that are going to produce the best outcome for the 401k. And so you're right, Fidelity is not managing it. And that's pretty much the answer on that. Now, if you want to open a brokerage account at Fidelity to invest in stocks, bonds, and mutual funds, you can do that, but you are still managing that account as the trustee, and you're making the investment decisions. You're selling when it makes sense. You're the trustee at the end of the day. The buck stops with you. So, anything to add on that, Dmitriy?
I think you nailed it. Again, with self-directed solo 401k plan, the client is the one who's in control. Fidelity might be a financial institution that provides the place to hold your money, right? But you are the one that is in control. So Fidelity will not be a custodian here. There is no custodian with the solo 401k. You are in control of your funds as a trustee of the solo 401k trust. You make those investment decisions. You deploy the capital. into investment, you move the money. So ultimately, you retain 100% control.
All right, thank you. Okay, and this is actually the last of our questions that were pre-submitted, and I do see some in the Q&A, so thank you guys for submitting those there. We'll get to those after this. Keep them coming if there's more, and if we don't get to them all, we'll circle back with you and make sure your question gets answered. This one comes from Joey. How do you borrow from your self-directed 401k?
Well, Joey, it's pretty simple to take a participant loan. You I believe referring to a participant loan and Brett, I think mostly addressed that question by answering another question. But we do have a detailed guidelines on the client portal. So Joey, that is the place you need to go. You need to log into the client portal. You need to go to the maintenance section and click on the participant loan, and then you'll see a step-by-step guidance there. We outlined there is a loan application there, all the guidance there, all the terms are spelled out there, and you just follow that complete loan application, do the loan calculator, figure out how much you want to take, figure out what will be your payments, and then you can simply write a check to yourself from the 401k with the memo line, a participant loan, and deposit that to your personal checking account. And now you're in possession of those loan proceeds, and you just have to repay according to the amortization schedule. But again, go to the participant loan section on the client portal. Well, that concludes our questions that were pre-submitted during the registration, and we have more than a dozen questions here. So quite a few more been added today. So let's not waste any time, Brett, and jump into those.
Okay, sounds good. Thank you, everybody. All right, this one comes from Grant, and Grant is saying he's taking the required minimum distributions, reporting to IRS, and his question is, I can just write myself a check, right?
Well, Grant, it depends. If you're talking about a solo 401k, then yes, you can write yourself a check for the distribution. You will have to pay the taxes on the distribution, and we do provide guidance on how to do that. So again, go to the client portal, and we have resources for that spell out how to take the distribution. If you did not specify what account you have, whether you have an IRA or 401k. If it is an IRA, then RMD have to be handled by your IRA custodian. So IRA custodian will have to handle that.
Yeah. Okay. And the next question here is a really good one. In fact, it's a topic that a lot of people don't want to address, but the stats are out that 10 out of 10 of us are actually going to die someday, right? So here's his question. This comes from Daniel. Thank you, Daniel. For estate planning purposes, how am I supposed to transfer ownership of an IRA-owned real estate upon my death? I have the proper beneficiaries in place for the actual bank account, but what are the rules or transferring the actual real estate upon death of the IRA owner?
Well, yes, good question, Daniel. Let me just comment that you will not be handling that. If you're gone, you're gone. So your beneficiary will have to take care of that. But good for you that you're thinking about this ahead of time, and all of us should be thinking about this. And you need to think about this so that your family can avoid a nightmare. And I've seen some of our clients going through that nightmare where the client passes away, and the spouse and children, now they don't know what's in there, especially with the self-directed account. They might know exactly what assets are there. So what you should be doing actually right now is you need to have that create a spreadsheet of all of your alternative assets in your retirement account, whether it's an IRA or a checkbook IRA or a solo 401k. Have that spreadsheet. Maybe update that once a year, and make sure that your beneficiaries have a copy of that. And if now to your question, if you have an IRA, then the beneficiary of an IRA will inherit that IRA. So they will not be transferring those assets from your IRA into their own name. They will have to transfer that to an inherited IRA. If it is a spouse who's inheriting IRA from deceased spouse, then that IRA basically can be not renamed, but the spouse beneficiary will create an IRA in self-directed IRA in their own name, and then those assets will be transferred directly into an IRA. If it is non-spouse beneficiary, then they will have to open an inherited IRA, and those assets will have to be rolled over from your IRA to your beneficiary's self-directed inherited IRA. And then from that inherited IRA, each account owner can take a distribution. And if it is a property and if they want to distribute the entire property, that can be done as an in-kind distribution. And that's when the property is retitled. Property will have to be appraised to determine the value for the reporting purposes, but that will be the process. And our team can guide you through that. So again, make sure that you understand the process yourself, make sure that you prepare your beneficiaries, and then work with our team to help you facilitate that. Moving on to a question from Harold. If I take out IRA funds, how long do I have to replace those funds without getting taxed? Brett, you want to take this one? We can hear you. Brett, we can hear you.
How about now? Sorry about that.
Okay, go ahead.
All right. I'll give it a whirl, but you might have to add some color to it, possibly. So first of all, you probably don't want to take out any IRA funds at all, just for the simple fact that you could create a taxable event and cause an early distribution and some penalties as well. There is something, and Dmitry, this is where you probably need to come in. There is something to that. I've heard that if you are going to roll an IRA over into a solo 401k or even transfer an IRA into another self-directed IRA, you can take possession of the funds, and you have, I think, 60 days to get that money into the new account without creating a taxable event. This is definitely something that I'm going to refer you back to your tax professional on, whether I think I'm correct about that or not. But perhaps you, Dmitry, can add some more on that.
Sure. So yes, you're correct, Brett. This is called the 60-day rollover. But Harold, we will need to clarify what is the purpose behind this, what it is that you're trying to accomplish. Yeah, potentially you can personally get to use your IRA money tax-free for a period of 60 days, once in 12 months, okay? But remember, if you don't return this money within 60 days, this will be a taxable event for you. I've heard people talk about, hey, you can use this money to maybe flip a property personally, get access to this money of your IRA, pull this out and then repay it. You don't owe any taxes. But again, if you late one single day, then that will be considered a distribution. And a distribution is subject to taxation, and premature distribution is subject to penalties as well. So I will not advocate for this. This is not the way to use the 60-day rollover. If you're doing, in fact, a rollover into a self-directed IRA or 401k, don't use a 60-day rollover. Do a direct rollover where funds go directly from your IRA custodian to a new IRA custodial or directly to your solo 401k. But don't take possession of the funds. That's not something that I will advocate. But again, I would, if I were talking to you, I will try to learn a little bit more what it is that you're trying to accomplish.
Okay, Joey asks, when I invest money from my solo 401k in a CD and generate interest, do I report that income at the end of the year?
Well, Joey, good question. If you invest your money or your 401k funds, doesn't matter how you invest those funds. Those are investments of the 401k, not your personal investments. So whether you're buying a CD with 401k funds, or you're making a private loan, or you're buying real estate and you get rental income, or you invest it in the market and just get dividends, that's not your income. So you don't report that income on your personal taxes, because that is not your income. It's just like, because look, 401k is a separate legal entity from you. You don't report income that Dmitry received during the year on your tax return, because it has nothing to do with you. Same thing, your solo 401k is a separate legal entity from you. You don't report that income. So it's income of the 401k.
And I think too, some people think you have to report, have some kind of reporting to the IRS annually with the solo 401k. And there really is only one thing to report, and that's the 5500 EZ form. It's 2 pages. And essentially what you're doing is you're putting on there what the beginning total plan asset balance is at the beginning of the year, and then at the end of the year, 2 different numbers. And then there's some more to fill out. It's not a hard form to fill out. You can go check it out on the IRS website, but you only have to do that if by the end of the year, December 31st, you have more than $250,000 of total plan assets. That said, it's not a bad idea to get in the habit of just doing it even before you get to the $250,000 threshold. But there's no other reporting requirements for the solo 401k.
All right, next question from Namurata, I believe. What are the best forms of passive investments you recommend in the solo 401k, and how to invest them from the 401k? Brett, you want to take this one?
Sure. Yeah, happy to. Look, at the end of the day, I think it's important to make investments on what you are comfortable with, what you have a little bit of knowledge on, and probably even have some experience in. Most of our clients want to invest in real estate in some way, shape, or form, but primarily, not 100% of the time, but mostly it's because they have experience doing that already. Typically, they're already a buy and hold investor, and they have money or have real estate that they own in their personal name or in their trust or whatever, but they've tapped their funds. They don't have any more. So now it's like, okay, how can I acquire more real estate? Or they do have more money, but they want to start growing their retirement portfolio in a tax deferred way, or even on steroids with the Roth, and they start investing in real estate. But again, they know real estate. I and Dmitry, now, we're not necessarily qualified to give financial advice and say, hey, this is a good investment or this is a bad investment. What we can do is talk about our experience and some stories we've heard from other clients and such. When you are making an investment, as the fiduciary, you want to look at everything involved. You want to make safe investments, but you want them to have as healthy a return as possible as well. And so there's really no single answer to this, but my advice is that you make investments on what you're comfortable with. And if you are going to, bet on something that you don't have any experience with, like if you have never purchased cryptocurrency, if you do to start with, maybe do that with some money that you're okay losing. I don't know. That's my advice. If you're going to do it and you're not comfortable with it and you don't have a lot of experience with it, probably test it out first with a small amount of money that it's okay if you don't get back. And I use crypto as an example, just as an example, for no other reason. But that's my advice. Invest in what you already know, what you're comfortable with, and you're probably going to have a better result because of it.
Yeah, and to add to that, Brett, is that we don't recommend any investments, okay, Sense Financial is not here to recommend investments. We don't recommend any investments, and that's going to be up to you. What will be the best investment for you in particular situation? Well, there is no investment that one size fits all. What might be best for me might not be best for you. What might be best for you might not be best for Brett or somebody else. So it's all relative. Like Brett said, this is depends on what you have experience in, and there are better investments that work for certain situations. There might be other investments that work for others. Yeah, there are generally certain investments that work better. But again, we don't recommend any investments. But look, if you want to chat about that specifics, we're investors, and I tell my clients, look, we don't offer investment advice as a service, but if you just want to talk to me as a one investor to another fellow investor, I can share with you my experience, and we can kind of brainstorm. I'm always open to do that with my clients, but we just don't make those investment recommendations. All right, with that, moving on to a question from Vinay. I think it's a follow-up to a previous question. If you do that, do you have a potential to save twice, 23K on W-2 and 23K on a solo 401K? And I think Vinay might be referring to the question that was, I think, pre-submitted. On I'm trying to find that. Yeah,
He asked what? Go ahead.
Yeah, the question was, can you contribute to an IRA in addition to a 401K? Well, IRA contribution limit is not $23,000, so you won't be contributing 23 plus 23. Contribution limit for an IRA for this year is $7,000. If you're over 50, that's additional $1,000 in a catch-up, so $8,000. Contribution to a 401K will be $23,000. So it won't be 23 plus 23, but potentially you can do 7 plus 23. You can do that. And then moving on
Can I add to that?
Yeah, go ahead, Brett.
Yeah, so just to be clear, if you have a W-2 401k and then you also have a business that you run and you have a solo 401k, it's important to remember that the employee contributions are per person. So Vinay, you can't double up on that, even if it's a 401k and a 401k. It's if you contribute $10,000 to your W-2 401k, you only have $13,000 more to contribute on your solo 401k. Okay, so I just want to make that distinction. Obviously, you have that additional catch-up contribution of $7,500 on top of that if you're over 50. But just know that they're separate contributions depending on the different 401k plans, but they're per individual. So I just wanted to make that distinction.
All right. You want to go ahead and read next one, Brett?
Sure. Yep. So this is from Namrata. I hope I'm saying your name correctly. Are buying specific stocks, crypto, is that considered active income and subject to UBIT tax?
Buying stocks is not an active income. If you own stocks, that's or cryptocurrency, that will not be an active income. You'll be getting dividends on that, so it will not be subject to UBIT tax. Now, I think there are some funds, crypto funds, that doing some kind of I forgot the term, mining. That's the term I was looking for. So if you're investing in some kind of a fund that is mining crypto, that might be considered an active income, but you want to, again, double check with your CPA. Typically, it's passive income, will not be subject to UBIT tax. Next question from Tom, who's asking, by when can I contribute to a Roth IRA for 23 and 24? But you want to take that?
Yes. It's by the tax filing. So it's by April 15th is for the Roth IRA. Correct me if I'm not
So
correct on that, Dmitry.
for 2023, it's too late to contribute on IRA.
Right.
So it's April 15, sometimes it falls on 16th or 17th, depending on the weekend. But yeah, so April 15 will be the deadline to contribute to a Roth or traditional IRA.
Looks like we have another question from April here. For the solo 401k checkbook, how do I open a high yield savings account?
Well, April, if you wish to open a savings account for a 401k, you certainly can do that. Just like you opened a checking account, you can open a savings account. Just remember that the account must be opened in the name of your 401k trust using your 401k tax ID number. So if you have your plan documents, you do have a letter from the IRS with that tax ID number. And as long as you open the account in the name of the 401k using the tax ID number, you will be the person responsible for that. So they'll ask for your name and your social as well, but the account must be open in the name of the 401k. Moving on to question from Ty, to add to the question about the 401k rollover to a solo 401k. Can I roll it over and use it to buy a personal property for oneself? And I'm just going to say, no, you cannot buy a property for yourself with a solo 401k. You can only buy investment property. You personally cannot receive any benefits from a solo 401k. So that will be a prohibited transaction.
Now, let me add to that real quick, if that's okay. So definitely you cannot do that right away. However, what you can do is you could buy an investment property, buy and hold rental, and let's say upon time of retirement, you actually want to turn that into a personal residence. You can do what's called, and correct me if I'm wrong, Dmitry, I believe that would be an in-plan conversion. Do I have that correctly? Or distribution.
Distribution.
Yeah, and so you can distribute that asset to yourself as opposed to distributing liquid cash to yourself. You can distribute the asset to yourself, and check with your CPA, because of course you're going to end up paying some taxes on that if it's in a tax deferred account. But you can distribute it to yourself and use it as a personal residence or a second home, vacation home. You can personally use it at that point. You can again check with your tax professional, but I do know that it's possible to distribute a small portion of that home, as an example, over the course of several years, so that you're not taking one massive tax hit. But you can't use it until you fully distribute it over the course of several years. So that is one way to kind of get around what we were just talking about. But initially, you definitely cannot use that for personal use.
Yeah, we do actually have a client who we set up a solo 401k a number of years ago. They purchased a property in Belize, and they intended to use that property as their primary residence at retirement. So actually, they contacted me maybe a year or two ago, and they end up retiring. They did take that property as a distribution in kind, and now they own the property. And obviously, once you own it, you're free to use it however you wish. But again, while 401k owns the property, you're not allowed to use it, period. So there is no way you can use it personally while 401k owns it. Once you distribute from a 401k, then yes, you can use it personally. Next question from April. In the solo 401k, what different ways can I invest besides real estate? Brett, you want to take this one?
Well, sure. Yeah. I mean, the possibilities are almost endless, right? You can invest in anything IRS says except for collectibles, and then for self-directed IRA, collectibles and life insurance policies, life insurance. Pretty much anything else is on the table. So that's the easiest way to answer that. If you have a specific question, feel free to reach out, but the possibilities are nearly endless.
That's true. I'm into that.
All right, let me read this next question by Gary. Thank you, Gary. If I want to take a loan out of my solo 401k in the next week, where do I get the proper rate to charge? What is the current prime rate plus 1%?
Well, you can easily look up the prime rate. If you go to the client portal and go to the participant loan section, we do provide a link where you can look up the prime rate today. So it's pretty easy, and you can just Google that too, and you can find that. But again, go to the participant loan section on the client portal and follow that link. Next question from David. I have a solo 401k with a rental property as the investment. I have just retired and no longer doing business. How do I transfer my solo 401k to a self-directed IRA account? Well, David, in this case, you will need a self-directed IRA, and you will need to transfer those assets over as in kind. You can transfer property, you can transfer alternative assets from a 401k to an IRA. That happens every year with some clients. We do that on a somewhat regular basis now as people retiring. Feel free to reach out to our office and we will guide you. And then we can terminate your solo 401k plan. And
David asks, go ahead.
Last question here. Can you take out a loan against your solo 401k to buy a primary residence?
Yeah, and we did talk about that earlier, but if you didn't hear it, that's okay. You can. The answer is yes. You can borrow it for a primary residence, and then instead of paying it back in 5 years, you actually have 15 years to pay it back. So the simple short answer is yes, you can do that.
All right. Well, that concludes our Q&A for today. That was the last question. Thank you guys for joining. If you're watching this on YouTube, give us a like, subscribe to our YouTube channel so that you can be notified of the future releases. And if we did not answer your question for some reason or didn't answer it fully, we certainly want to provide you with the answer. Reach out to us. You can schedule a consultation with either myself or Brett, or you can just email our office or email one of us directly. If you're a client, we'll be happy to do that for you.
All right. Thank you, everybody.
Have a great rest of the day.